And do I not have volume? Yeah, I just realized I forgot. Yeah, no sound. Hang on. There we go. Yep. Sorry, I forgot to turn on the other screen. All right. Anyway, for those of you that can read lips, I'll make sure I put the timestamp here. So all I was saying is there's a lot of this is what I said in a nutshell. There's way too much emphasis. Number one, there's way too much emphasis um, on individual earnings, right? So Google case in point. All right, Google case in point. When I'm looking at Google, right, what we have now is a high concentration weighted stock in the Nasdaq, somewhat in the S&P. Remember, this is one stock of 100 within the Nasdaq. This is one stock of 500 in the S&P. Where else is Google going to have impact? The XLC. So a lot of times there's this notion, and I think it's just said oftentimes for effect, that a single stock somehow has the fate of the broader averages in its hands, right? I've heard the same thing about Netflix. You'll hear the same thing about Apple, right? No one stock has that much power. It can help a sector, it can help an index, but unless what it creates is a rising tide within that index and within that sector, no one stock can do it alone. Just like no one stock is going to drag an index down, right? Let's take a look at something like Tesla. Tesla has been woefully lagging the all-time highs in the S&P and generally the highs in the Nasdaq throughout the year. Suddenly, and quite, with a gap, suddenly it's caught up, right? But remember, one stock is not going to undo the broader averages any more than one stock is going to save the broader averages. You'll hear hyperbole like that from time to time, mainly because, well, it garners a lot of attention, right? Oh my gosh, Google's going to save us all. Netflix is going to save us all. Fill in the blank. And it's no more the case than Tesla, which had been moving lower as the S&P punched up to all-time highs. That one stock really didn't have that much influence. So that's the first thing we got to think about. A stock's weighting within the index and a stock's weighting within the sector. And that sector's weighting, and this is the really key part of it, that sector's weighting within the index. And if an individual stock can have that much influence or not, my hypothesis, my experience, right, is no, it does not. But hey, good for folks in Google, just like good for folks in Tesla, right? That's where we are right now. Now, if we step back and take a look at where there's some really good clarity, there are trends out there, right? Tesla's hardly a trend. Google's hardly a trend. There are some trends out there, probably none more so than the S&P. The S&P right now, and you might say, Rog, it's wobbling. Granted, but there's some interesting things happening that are disproportionately benefiting the S&P and the NASDAQ, right? And not so much the Russell and not so much the Dow. The disproportionate benefit is when those individual sectors within the index start to move higher with more participation in the stocks and sectors weighted within it. So that's why things like, and I'm going to go there because I need people to really understand and think about what sector and stock weighting means. This is why things like put call ratios, this is why things like tick, TRIN, advanced decliners, I don't know, fill in the blank, your favorite market internal. Now, rather than me saying they don't measure the market as they really are comprised, which is true, go back and maybe do a Google search on how the calculation of, say, the VIX, that's another one, right? Do a calculation how it's made. What are the components and then how those components calculated. And what you'll see is that there's one fatal flaw in every market internal. If we lived in a world where the SPY or the ES was an equal weighted index, which is also a ridiculous notion to change the weightings. I see a lot of folks saying, Rog, what about equal weighted indices? What about custom indices? Nonsense. There is a way that these are already calculated, right? There's a way these are already calculated. We don't need to get cutesy about it, right? Oh, I'm going to make my own S&P index. Why? Right? We already know what's weighted and how much it's weighted. How about just acknowledge that's the reality? And that's the problem with market internals. They, like, for example, the VIX, which is based on SPX options, all of them. Does anyone think that stock weighted number one in the SPY is maybe a little bit more influential than stock weighted number 499 in the S&P? Of course it is. But market internals are not calculated in that way. Therefore, like an equal weighted index or like some, index someone wants to cook up, some custom S&P, right? They're out there, right? They're out there. They're not measuring the thing as it is, right? And, I like to say, if we're all baking cookies and someone said, well, you need eggs and flour and sugar and milk and oil and whatever, right? Chocolate chips. Now add them all in equal amounts. What do you think you're going to end up with? A cookie? Portion measurements matter, right? Try making a cookie with equal amounts of all the ingredients. It will be fairly unedible and useless, much like anything that deviates from the actual weighting of the indices that we trade, or things that supposedly measure what's happening in them without the proportions, right, that they really have. And these are things that hurt traders, right? These are basic concepts, putting too much emphasis on earnings, putting too much emphasis on market internals. And I say this because most traders do this. Now, I mentioned before the S&P and the Nas are doing better because of the sectors that belong to them, right? Why is the Dow not keeping up pace? The Dow's not keeping up pace because while financials are the number one weighted sector within them, some of the other sectors are just not as strong as tech. Now, tech plus financials is great for the S&P. Tech plus tech is great for the Nas. But the Dow needs things like energy, healthcare, industrials, transports. The Dow needs strength in things like XLE and in XLV. And the S&P doesn't quite rely on them. They're influenced somewhat, but it doesn't rely on them quite so much because the S&P is basically a lot more Nasy than it is Dowy, right? So keep that in mind when you're asking yourself, where is the potential follow through? Now, this morning, we're going to be opening up below the previous session close on all four of the indices, which isn't a big deal. But right now, as we start the day, we're trading below yesterday's previous session cash close, which is 4 p.m. Now, that's a line in the sand, right? That's some terminology probably most of you know I've been using in our classes for years now, right? So what is a line in the sand? So when I say something like line in the sand, what I mean by that is that there is a sentiment level that if we're above, it's sort of the bullish hemisphere. And if we're below, it's the bearish hemisphere. So that means sentiment tends to favor a bias of being long puts or short versus being long calls or long. And if I can figure out that sentiment, we have a much better probability of, you guessed it, follow through, right? So right now, the follow through is probably going to favor the downside a little bit as long as we're below that previous session close, that line in the sand. What other lines in the sand are there? I have a couple of them, 3 of them that I like to use. One is the most simple. It doesn't need an indicator or anything like that, but we have one anyway because folks ask me, Rag, I know it's the previous session close. I know I just have to look at the 4 p.m. Price, but could you make an indicator? So yeah, the bot said, look, Rag, people want a previous session close indicator, so let's make it a good one. So what we did is we not only gave you that previous session close, that line in the sand, right? Price. We let you know how much above or below it is. And then we put a line on the chart. See this right here? This kind of orange colored line. Then we put the line on the chart. So when I say we're below it, that's exactly what we're looking at. There's another one that I look at, and the other sort of line in the sand, a sentiment level that gives me some insight about bullishness versus bearishness, is an anchored volume weighted average price. So I like that one a lot. All right. I like that one a lot. The anchored volume weighted average price. And now the anchor is the key. Now be careful, gang, because there's a lot of folks out there, anchored VWAPs weren't really all that popular for a long time. There's a couple traders that use it a lot. and it's much more powerful. Some of you might, I got a buddy, his name is Brian Shannon. He does a lot of great work on an anchored VWAP, but he's always said the anchor is the most important. I agree with him. I think he's absolutely right. It's not the only tool that I use. It's a really powerful one. A VWAP is not anchored. It's just sort of rolling. I don't like VWAPs. It's got to be anchored. So the second part of it is, where are you anchoring it from? So you've got to have a consistent way. I don't change the anchors. That's the next thing. So some folks have realized a VWAP is far inferior to an anchored VWAP, 100%. The next thing is, where are you consistently anchoring it? And this is where a lot of phony baloney has been running around. People just anchor it randomly, right? That's not really the best way to do it. There should be a process by which either there's a price pattern, a particular date, a particular time, some sort of volume, something that you can consistently say, this is the point from which I want my anchored VWAP to start measuring whether or not price is below or above the level. And these are little things called, lines in the sand, sentiment reads that help me. And the last one is something we call the dots, because that's exactly what they are. And those dots are loosely based, because there's a lot more into it, but they're loosely based on a 200 period exponential moving average. Those are three different lines in the sand, right? Sentiment reads that give me an idea that, for example, the ES this morning is sitting below all three of them. So until it can incrementally make its way above those, right, I'm really looking at what would potentially be a tough climb. Well, the next part of this would be, well, what would help the ES climb or the NQ climb, right? Notice Google didn't save the day. The NASDAQ is still sitting below all those levels that I just showed you on the S&P. So what could help that out? Well, it's Wednesday, so there are some economic events. At 8:15, we had the ADP number, which is the automatic data processing. It's the private number. It's not really used in a way that would, I would say, nobody thinks this ADP number is necessarily a harbinger to the non-farm payroll number we're going to get on Friday. I mean, it might be a little bit, as far as considered a piece of many different data. It might be JOLTS, it might be initial claims, there might be a lot of different jobs data that kind of factors into what might be discounted and expected for Friday, but it alone is not that influential. Probably one of many pieces that would contribute to an overall opinion. We have GDP coming out at 8:30, right? That came out 45 minutes ago. It was a miss. Now, this is where, because we have started the rate cuts, now there was a time before the rate cuts where good data, right, was considered bearish, because it basically seemed to imply that the Federal Reserve had time to act to start cutting rates before they actually did. So the worse the data was, the more it put the screws to the Federal Reserve. But now that they're cutting, the good is bad is not all that clear. Now that they're cutting, we want to see that inflation is still either flat or moving lower. We want to see that there's some growth, although it's probably a little too soon, but we want to start to see there's more growth as lending and borrowing costs become more cheaper, right? It's cheaper to borrow. It's less expensive to lend. That might take some time to factor into the GDP, but there are certain data points now that, if they are amiss, are going to be bearish. And I would have to say largely this advanced GDP is. And then we want to see where the weakness starts to kick in, right? And you could definitely see that the weakness started to kick in after 8:30, not so much after 8:15. So that better than expected ADP really didn't do much. It was that miss on GDP that started to take what was already sort of a weak. Take a look at the ES here. It's already kind of weak. Wasn't super strong. But these are little things that, if you want to understand what's influencing the broader averages, all right, so here's your S&P. This right here is your ES futures on a 5-minute time frame. And then take a look. Yeah, we were kind of meandering, right? This is 6:30. Nothing really important. That was 7:45, right? Here's your 8:15, that crazy wick, but still, we kept the range. And then that 8:35, so right after, and 10 minutes after the GDP, things started to trickle down a little bit, right? Nothing major, but it started to trickle down a little bit. And we've been below the previous session close since 6:45. So nothing's really changed that. If you want to know what's influencing different indices, maybe you want to do the same thing with bonds. Maybe you want to do the same thing with gold. Maybe you want to do the same thing with the NASDAQ, whatever. Look at the time that the moves are made. And this is something we do every day in the mastery. Time is one of the 4 factors that influence the markets that we trade. Time, volume, volatility, and of course, price. But most traders start and stop with price, right? They're looking at chart patterns, they're looking at open, high, low, close. They're looking at indicators that calculate open, high, low, close, right? So when you start to add in volume, when you start to add in volatility, and you start to add in time, now you're looking at the broader averages in more of a 4-dimensional kind of way, rather than a flat 1-dimensional price-based indicators, price action way. And I know a lot of folks like price and price alone, and that's great. If I've got more factors where I can add some depth to the topography, right? I can see a little bit more the difference between a hill and a mountain. I'm going to use that opportunity to do that. But we have to do it in a consistent way, like I was alluding to before with, say, an anchored volume-weighted average price. All right, gang. So that's a wrap. I don't see any questions here, but sorry about the sound earlier. My mic just did not register. So anyways, thanks as always for being here for Charts and Coffee. Sorry for the technical difficulty. I'll see you tomorrow, same time, same station, gang. Be good to each other.